Hi, this is Mike, and today we're looking at the Dow Jones Industrial Average Index. So I'm going to talk about the bigger picture here. Now, I do this from time to time, but as I get better at looking at waves and understanding how they move just by observing them at all degrees, I start to see things that they just amaze me. Now, this is not something that I've just discovered according to AriasWave. It's something that I want to rehash on, retouch on, recap on. Before I go to the bigger picture, I want to show you something that I have come up with as a theory as to what the bigger pattern is in the Dow Jones. Now, this one, it convinces me almost more than any other one I've done. So it all starts with the Great Depression crash, which is why we're looking at this right now. So the Great Depression crash, in my opinion, was a expanded zigzag pattern, right? It was the largest crash ever, and it's probably not the last one that'll happen like that. I don't think, not by a long shot. Now you got to think about it this way first. Before the Great Depression, you look at all the patterns that happened before that. You can go back to like 17, 15, 1600. They joined the European chart on. And it's not easy to determine what happened before that. And I have some theories on what that could be, but the thing with AriasWave is that there are certain patterns that occur at certain times. And in the corrective process, the first wave is a zigzag. So given that this decline was 99% almost, probably like 90% or something like that, 89, 90%, to me, this is amazing. It's an amazing thing because that means that we have a line in the sand. And in a minute, I'm going to show you why it doesn't really matter what happened before then, because we don't need that analysis anyway. Okay, so the reason why I believe this is a zigzag pattern, sorry, is because you look at the first two waves that occurred. Sorry, the first and last wave that occurred, right? These are the longest waves within the whole structure, which is consistent with a expanded zigzag pattern, right? After the first move down, you had a zigzag pattern, which is wave A, right? Now, if this was to be a wave three, where's the midpoint, which is the longest, the strongest, and the longest point? Well, I can't see one because there is none, right? There is none, right? Take it like this. There is none, right? And if this is wave three, then why are these waves overlapping? Waves one, two, three, four, five. If you look at it like that, why is waves, one, two overlapping with wave four of the wave three? It's simply just not a five-wave move, like an Elliottian would think. So therefore, in my personal opinion, this move down here is a B wave, followed by a C, a D, sorry, followed by a C, a D, and an E, right? Now we know that E waves are five-wave moves, so if you look closely, you can see a weak five-wave move there, right? 1, 2, 3, 4, 5, right? Now, this is all good. I'm cool with this. I have no problem, and I've thought the same thing for a while now with A, B, C looking like that. A, B, C, that's the zigzag pattern, okay? And this is a type 2 expanded zigzag because wave B ended way below the start of wave A in brackets, right? Okay, so what does that mean? Well, given the following pattern, okay, before I continue, let's just understand that the Federal Reserve Bank was created in 1913, right? So back here. at this point, roughly during this time, the beginning of the Federal Reserve, and they said that they created the Federal Reserve to prevent future crises from happening, and then they crashed the market. It was a liquidity crisis, ended up in a 90% depression. Now, when you have such a large depression and you have the Federal Reserve in control, what do you think is going to happen to the next wave up? More than likely, it's going to be expanded like nothing you've ever seen before. And I believe that's exactly what happened, or what is still happening. The B wave, the larger B wave, in this case, we're labeling the largest waves 40 font size, right? Now, let's just go to the monthly for a moment. All right. So you're probably thinking, well, how can this be a B wave? Well, like I showed you before, zigzags can expand, right? In this case, to the upside, you've got way more potential than to the downside, because to the downside, you're limited by percentage. To the downside can only go 100% max, but to the upside, it's unlimited, right? As we've seen with cryptos, etc. Now, I'm going to show you the labeling for this, and I'm even going to show you what I believe is going to happen based on AriasWave. Okay. Now, there are some caveats here. So before you go ahead and have an opinion, just try to hear me out. So here we go. So the B wave that we're seeing here expanded from day one. Okay. It moved up, a 5-wave move, 3-wave move, right? And then we had a 5-wave move. Well, that can't be a zigzag because there's only one corrective pattern there. But we immediately started moving in fives, except for when we got up here. What happened around this area, right? What happened around here? Well, we had another 3-wave move, except this time the B wave was contained. It was rather small in comparison to what's going on. And then we had a C wave 1987 crash. And then what happened is that we had the first leg up of an expanding D wave that's still expanding to this day. We had the first leg up all the way up to the 2000, and then we had the dot-com crash, 9/11, and basically during this time there was a lot of credit default swaps growing and growing, because as you know, they were created by JP Morgan. Some bunch of 20-year-olds created them, but then they later became a monster used by other banks to create, mortgage-backed securities and all sorts of other toxic products that eventually led to the GFC. So in essence, we have a repeat performance here as what we did here, right? It's the same thing. Now, having said that, so we started A wave of the first part of a zigzag, A wave down the bottom, and then we started to expand in a B wave. So this is internally part of a B wave structure of the larger zigzag. So this is this would be the so where did my 32. So down here we're up to 32. So we're looking at the B wave, size 32 B wave up here, right? Up here. This is going to be the end of the B wave. It has not finished yet. What keeps happening is this thing keeps expanding. Same way you saw the Great Depression A wave go down, except this time there's no limit, except there is a limit, and that's called inflation. It's called boom and busts cycles, money printing, and probably just a lot of problems in society. If you ask me, that's my opinion. So after that GFC C wave, which was the same wave as the 1987 crash, we start expanding again within D wave of the now D wave. So D wave started expanding its D wave, and that's what's in progress now. Funny enough, the crash that happened in 2020 was another C wave. Okay, can you see the pattern? Small degree, you had your A, B, C, and then another expanded D wave, and the first move of that happened in 2021, right? So now we're going to start to see a lot of problems because all the chickens are going to come home to roost. And now we have to start completing all these zigzags that have expanded over time. So how's that going to happen? Okay, now I've drawn these 1, 2, 3s there just so you can see roughly how many more booms and busts we're going to see until this B wave ends. And then what comes after that, I'll explain to you in just a moment. It's going to get nasty. So it seems like these the ABCs started with 1987 crash and then got bigger and now getting smaller. It's only because of the subdivisions, right? I've even drawn these orange lines so you can see which B wave corresponds to which A wave. So which C wave will correspond for which B wave zigzag. Okay. Now there's only one B wave. Sorry, there's only one B wave, but within that you've got a whole bunch of stuff going on. Okay, so how are we going to finish this off? Okay, for starters, we need to finish off the D wave that's within this smaller D wave here, right? So we need to see a move up for the D wave, a crash in E, and then a C for that D. That'll be done. Okay, and then that D being done, which is the size 24. So basically, we're talking about the ABCs that started in 2000, ABC. So the size 24, D wave done. After that, and then we're going to go for another E wave, which is going to be part of the larger D wave, which is the one from the ABCs that started in the 70s and 80s, right? So you can just see that this is necessary to happen in order to complete the zigzags. And then we're going to see another crash, right? And then we're going to see another move higher to complete the B wave that started back in 1942. That's how big the B wave, excuse me for a sec. That's how big the B wave would have been since 1942. Would have been the whole reason this whole thing is expanded. Is the B wave within the larger B wave, right? Now to see the end of that B wave, well, we still need a C D E pattern. So then we're going to get yet another case of ABC. Sorry, 1 second. Right, another case of A, B, C. So this one will probably be one of the largest crashes in history when it gets to that point. But as you can see, these crashes are going to keep getting bigger and bigger and bigger and bigger, right? Now, the reason why I made D and E so small here at the end is simply because we need to have a C wave that's roughly the same length as the first A wave. So A in brackets, C in brackets, right? As I showed you on the Great Depression chart, the C wave can be a slight bit longer, but this is for illustration purposes. Unless we get the D wave expand as well. I'm not too sure about that. And it's probably too far off to talk about it anyway. But for the purpose of illustration, I've just made it this small. Imagine if that one expands as well. Now that would be insane. But just to give you an idea of what I see happening, this is the kind of thing that you need to be aware of if you want to be trading the markets from now into the future. If you don't know when to get in, if you don't know when to get out, why would you get in? If you're thinking buy and hold is the way to go, well, this is crazy. It used to be that way, but with the completion of these zigzags incoming, it's probably not going to be the case. We'll go for bull run, crash, bull run, crash, bull run, crash. That's my opinion. Using AriasWave, I've come to that conclusion. It's one of my theories that I've put on the board over time. But to me, this seems like it makes the most sense, because if you try to make these waves into something that they're not, it simply just doesn't make sense. Okay. But this way, it does make sense. And I can actually see why this would happen, but also it explains possible stagnation, stagflation as they call it, starting to occur after this point in time, which funny enough is when, is the middle, it's almost like the midpoint of this insanity that's still yet to complete. It's the midpoint. Right now, or right during this pandemic, seems to be the midpoint. I just find that so bloody interesting. I just can't help myself but say that, right? It's so interesting how it's the midpoint. Wow. That means from here on out, even though we might think it's the pandemic, it's a good reason to suggest it might be the pandemic that causes all this to happen moving forward. But is it really though? Is it just something that probably has happened many, many times over history, but now we have the biggest example of it that can be illustrated using technology that we have today to observe the waves in such fine detail, something that wasn't around during AriasWave's time. This is why I say AriasWave is old. This is new. This is accurate. It can be used to trade at any degree, but it can also give you an understanding of what you should expect moving forward. So hopefully you found this video interesting and informative. Thank you for watching.